Hello. Today is the 26th. We have a holiday shortened session next week, thanks to Memorial Day. Now, what happened this week? Couple of things of note. First of all, we had the passage of the one big, beautiful bill in the House. And we'll talk more about that later because it is slightly fiscally expansionary. What the Senate will do with it is an unknown at the moment, but probably not very much. So a net positive for equities. And despite that, they gave up, close to 3% this week. It's obvious that the market had been overambitious in what it expected to happen from that bill, but also tariffs are not over by any stretch of the imagination, as Trump reminded us on Friday with his tweet about threatening a 50% tax on the EU, which the market really took not too bad. I mean, we ended up slightly down, but it wasn't really a disaster because I think the market is beginning to recognize that these are negotiating tactics. And the likelihood of the EU ending up at 50% while China is at 30% is really not all that high. So the market is worried, but it's not hugely worried. Otherwise, what is going on is exactly what we have been saying consistently over the past several weeks, is that the window of opportunity for weakness from the Liberation Day tariff episode is now open. And if we are going to get some weak economic data, and if the economy is to weaken, it's going to happen in the next 4 to 6 weeks maximum. So that is probably another reason why equities are slightly cautious, because they recognize that that is a significant possibility. Not 100% probability, but nothing in life is, but there's a significant possibility that the economic data, the real economic data, starts catching up to the soft economic data over the course of the next month. Otherwise, even next week, we have very little data, but let's discuss what we're doing, what we are thinking of doing, and why. Andy, do you want to give us an idea of where you think we are? Because we are getting to some interesting levels in real yields that we might want to take an opportunity of buying, but we are really not quite there yet in anything, are we?
Yeah. So let's review where we are. So Nick talked about this window, which we've been sort of targeting for really since January, of when the combination of the Fed being on pause and higher long-term bond yields and the Trump administration's policies that were relatively anti-growth were likely to show up in data, because data always lags these types of things. And 6 months, call it on the election, 6 months ago, animal spirits were fairly high. And so the economy wasn't going to weaken with the new Trump administration being elected and a, frankly, relatively stimulative Fed that was in the midst of cutting. But that all played out by January. And now the animal spirits are at least chastened, if not gone. And so that's going to start showing up in data. And so what Nick was saying is we've been targeting this next 4 to 6 week window as when the reported hard data would start to weaken. That's a little different than saying that somehow we think the economy will strengthen in a sort of longer term horizon. While we expect the data to weaken in the next 4 to 6 weeks, if it doesn't weaken, that doesn't mean, gosh, we're about to go on to some strong economic run. The pressures remain. The Fed is on pause, probably more so than ever. The fiscal policies are developing into anti-growth policies, though they can be subverted, and I'll mention that briefly when I finish. And yields are high. And so the economy is likely not to accelerate, even if this data window passes. So I just want to make sure you recognize that we're not saying, gosh, once this window closes, it's off to the races for the economy and for assets. Though what it does mean is that there's a fair amount, given what's priced, there's a fair amount of opportunity if the data does surprise on the weak side, which we expect. So I mentioned one thing that I think is left. There is the possibility that, and certainly the promise of the Trump administration, to enact some very serious deregulation. And while the easy deregulation potentially pushes capital onto industry and investors, that's called bank regulation, deregulation. What the hard deregulation is the pull deregulation, which encourages real economy investment by companies and individuals because they don't have to pay the costs of regulating themselves as high a cost as regulating themselves. And so we haven't really seen any of the second form of deregulation, and we have seen and saw again this week a fair amount of rumors about, not just rumors, we're going to change bank regulation. So that has a possible upside for stocks over bonds. I just wanted to mention that in that it's a developing story. Alternatively, all the rest of the stuff is still bonds over stocks. And so here we are looking at bonds and saying real yields have become much more attractive. They haven't reached the targets that Nick and I have mentioned to you a number of times, something like 3% on long-term real yields, but they're getting close. And so you have to ask yourself, well, here we are. We've been very conservative in our investments for many, many months, both in stocks and in duration. When do you buy some? And I think we might have an opportunity this week to buy some duration or buy some equities, but probably not both. And so that'll depend on the developments this week.
And how do you see this development this week? Because it's going to be binary. Either Trump is going to enact some threats or he's not. And we won't know that until June the 1st, most probably. But you never know with him. He could tweet at any time.
Yeah,
but
June the 1st
just happens to be a Saturday, so we won't know anything until the next Monday. So it really is, he's making it as difficult for investors as he possibly can, isn't he?
Yeah, I mean, what do we got? We got June the 1st. I have it as a Sunday next.
Yeah, whatever, it's the weekend.
A week from tomorrow. So we've got 50% on tariffs on Europe coming a week from tomorrow. Okay.
But what are the odds of that? They've got to be minute.
That's pretty heavily anti-growth and pretty disastrous. So what's happened? I mean, let's talk about what's happened. Liberation Day, we were heading toward a slowdown before Liberation Day because tariffs were going to be high. The Fed was on hold. The budget was Doge was going to cut massively. The budget was going to be hawkish. Fed was on pause and interest rates were high. And we went into Liberation Day and holy moly, all those things caused an overreaction. And boom, we went down to 4,800 on the S&P. And then a week later, anybody who sold looked like an idiot. And so why? Because he paused the tariffs. He didn't do Doge cuts. He, as of now, has a House bill that is modestly expansionary in 2026, does make some cuts, but gives all of that away with tax cuts. Well, where is Mr. Hyde? Mr. Hyde took people panicked at 4,800, and now he doesn't exist anymore. And so we were at 59.70 or whatever it was a week ago. Anybody who sold looks like an idiot. So are they going to sell next week? Sell aggressively based on a 50% tariff that isn't possible? Of course not. Nobody's going to be stupid. But what will the tariff be? It won't be a UK great deal. It won't be a deal at all. Let's be clear. There will be no deal between now and June 1st, no matter what. You put a 50% tariff on the EU does not say, hey, what will it take? Let's come to the middle. We want to. They say we're leaving the table. This is ridiculous. So what's going to happen? Either Trump softens his tweet. There's just nothing that's going to happen. We're going to end up on June 1st, and there will be no deal. And there will likely not be a 50% tariff, but, there could be. So I don't know. I look at this sort of thing and say, no one's going to get duped in listening at Trump use his, what is now clearly to everyone on the planet, a negotiating strategy. No one's going to get duped to extrapolating 50% tariffs on Europe and take down the global equity markets. No one's going to get duped like that. So at the same time, no one's going to buy equities ahead of whatever happens because it's not, what's the upside? So I look at this sort of thing and say, what's going to happen? We're either going to get some Trump tweet that is going to be softer or nothing between now and the weekend, the next weekend. So if we get nothing, equities are going to be down, bonds are going to be up. If we get something, equities are going to be up a little bit, bonds are going to be down a lot. And so when I look at those things, I say, oh, by the way, when I say equity, in the first case, we get nothing and we walk into the weekend with 50% tariffs still hanging over and no caving, equities are going to be lower than where they are today. They could be modest, a fair amount lower, enough that it might be worth a shot to buy some and get back to what is, just a low allocation to equities. Similarly, if he caves next week and bonds are going to sell off, and if bonds sell off, we're getting to a yield that becomes interesting.
Yeah. And that is what I was waiting for, because if bonds do sell off again, you're getting to that 385 real yield that is beginning to interest me on this, because I just think it's very unlikely to hold there for a long time. Either we're going to go massively higher, and I don't see what is going to cause that, or that kind of real yield really does start hurting the economy, and the economy really does then keel over and die, right, kind of thing.
285 is the first level that you want to start adding to duration.
Yeah. 285 is a wonderful level to start putting some real yield on at the long end.
You said could real yields go a lot higher? Yes, real yields could go a lot higher if the deregulation and or AI, and some of both, is massively productive. In that case, real yields are going higher. And if the government budget deficit expands more than expected, which is either a killing of the complete cave of tariffs or more stimulative fiscal. And the fiscal's mostly stuck now. The Senate may tweak it, but the fiscal's mostly stuck now. And so cut tariffs, increase productivity. You could see us being too early buying real yields at 285. But it's time to get started.
And the easiest way to do that is actually probably selling puts and just waiting to get hit on those, and especially if next week is bad. Because the real economic data next week, again, is very sparse. We have the only thing that is not in the rearview mirror is durable goods and also the weekly claims. And weekly claims have been stuck for such a long time, it's hard to see them moving. So durable goods are still going to be influenced by all sorts of front running of tariffs. So there will be justification, whatever the number is, there will be justification as to why it is what it is. So I don't expect next week for the data to actually be definitive and tell us which way the economy is heading. So all we have really is Trump, and we want to basically play whichever way the market ends, we want to go against it, don't we? Because if stocks fall a lot, that will mean that we miss the bond market. But on the other hand, if as you said, if Trump softens his stance, then we have an opportunity to buy bonds. And I think we should definitely take it. Equities, again, what is a fair range for equities now? What do you think is a fair price for the S&P at the moment?
Right. So, and that
It's got to
question
be
is,
around 5K, doesn't it? Still.
yeah, I mean, 19 PE, we're at 21 now, 65-ish.
You think
That sounds,
265 we can get there? That's high.
yeah, well, I mean, 19 PE partly puts into that because we're at
Yeah.
21 now. I don't know. Listen, I think the idea that after all, we could be wrong. The idea after all this 120 days in the administration or whatever it is, and the policies that are trying to be enacted, and the financial conditions and monetary conditions where they are, we're going to have a slowdown. And if we're going to have a slowdown, equities are still rich anywhere above with a 5,000 handle on it. But at the same time, there's not a catalyst because there's not that fear. And so a slow grind down to that sort of level is more my thinking. And so for me, along that path, your job is to sell puts on equities equal to what you would otherwise want to own to increase what is for us a very low allocation in equities over time. And so, scaling, using puts to sell on any downturn, meaningful downturn, and then collecting that premium, not ending up buying stocks because it's not a waterfall down to this level, letting the market bounce, sell some more puts. That seems to be the way to. And if we waterfall down, great. We're way underinvested in equities and in long-term bonds, and this will provide us a way of getting invested well.
Great. Thank you very much indeed, Andy. Have a wonderful Memorial Day, and I'll speak to you next week.
You too, Nick.